Are you interested in investing in the telemedicine industry? Are you looking to invest in the leader of a relatively new sector set to experience massive growth in the future? Then Teledoc Health is definitely the stock you're looking for. If you haven't noticed, in the last few stock analysis videos I've made, I've been going deep on the telemedicine industry. I wish I looked into these stocks earlier because it's clear the health sector is set to boom as everything moves either remote or online, and I don't want to miss the boat. I have severe investing FOMO. I'm not sure why this hasn't happened sooner or quicker, but thankfully people have been adopting these online methods at an insane pace. The ability to deal with medical concerns online without a trip to the hospital or to the doctor's office is the way of the future. And the company currently in best position to help this industry take this leap is Teladoc Health. I'll start off by giving a brief breakdown of the company, then I'll take a look at their financials, and lastly, I'll give my opinion on the stock, whether I'm gonna buy it, whether you should buy it. Before I get into the rest of the video, I haven't done this in a while, but please thumbs up the video and subscribe to the channel for more content. Please turn on the notification bell so you get a little ring every time I release a new video. Teladoc was launched in 2002 and they went public in 2015. They list their services into 6 categories, which I'll read off right now. Platform services, guidance and support, expert medical services, mental health services, telehealth, and integrated virtual care. To sum it up in a few words, on-demand remote medical care, I guess. The ticker symbol for Teladoc Health is TDOC, TDOC, and it's on the New York Stock Exchange, so apologies to any Canadians, this is US only. Teledoc has recently merged with Livongo. I hope I pronounced that correctly. It's another company in the telemedicine industry. It was an $18 billion merger, making it the largest in the industry. Let's go over some basics, then I'll dive into their financials like I do on every video. TDOC is currently trading at $191 per share as of the scripting of this video. Market cap is currently sitting at 27.7 billion. No dividends, obviously. No PE ratio because they're running a net loss. Lastly, a negative earnings per share of $1.44. They were trading at $85 per share at the beginning of the year and have quickly increased over 220% to the current price of $191. They had a slight pullback recently once the merger was announced. It was trading at a high of $250 per share. I'm not sure why the market didn't like that. They'll be increasing their revenue by over $300 million per year by merging with another massive player in the industry. There's usually a decrease in the short term for the acquirer, only to increase in the medium to long term. Then Moderna and Pfizer announced that they have a vaccine coming out in a year, and the stock tanked even more. This is obviously an overreaction. Someone announces they have a vaccine, everyone overreacts and think the pandemic is over and that these digital stocks will die. So for now, investors will have to deal with a little bit of volatility every time the media clickbaits and announces something. Let's start by looking at their balance sheet. Remember what I've taught you in previous videos, just do some quick glances at numbers, just basic mental math. Assets greater than liabilities. Not sure why they didn't total the liabilities, but I included the number there just in case. Current assets are almost 6.5 times greater than current liabilities. That's awesome. This means with their liquid assets, cash or short-term investments, they're able to pay all their current debt, anything that would come due within a year. They've got more than enough. Just take a look at the 1.1 billion in cash on hand. It's more than doubled since December 2019. But it's obviously to continue their aggressive acquisition plan. I'll touch on where that number came from in a minute. Here's where the red flags should come up. I'm not saying this company is in trouble, but goodwill is 49% of their entire asset class. Goodwill is that's not an asset in my mind. It just means you overpaid when you bought another company. This is the premium you paid to buy a turnkey investment, a ready-to-go company. Almost 1.7 billion in overpayments. I understand this is part of the game. This is the technology and growth sector, and the issue is this number will only grow from here. Let's move on to the income statement. Teledoc, when comparing the 9 months ended 2019 to the same period in 2020, have increased their revenue by 179%. In 1 year, they increased revenues by 179%, both organically and by acquisitions. What's awesome about these telemedicine companies are the high profit margins. In 2019, they had a 67% margin, whereas 2020 decreased slightly to 62%. The only way to determine if this number is good, you need to compare them to their peers. While there isn't another telemedicine company as big that I can think of course, Looking at some of the smaller ones, they also maintain around a 60% profit margin. So it's great on its own and in comparison to others in the industry. Don't get too upset or worried that this company is running a loss. You want to see where the loss is coming from, where they're spending their cash. Looking at the expenses, you see a 50% increase in advertising year over year. That's great. You need to get the name out there. You need to advertise the company. I understand. Research and development up 50% again. This is good. For a tech company, you want them to spend more on R&D in this growth stage. Then, obviously, due to the large merger this year, the acquisition costs are up over 12 times over last year. All this totaling to a $91 million net loss and a $1.17 loss per share. Onto my favorite statement, the real test of a company's viability, in my mind at least, is the cash flow statement. Can their normal operations provide a cash positive position at the end of the year? Looking at their 2020 statement, for the first 9 months, they'd made $61 million in cash from their operating activities. This is awesome. You might think, of course a company is supposed to be cash positive. But for a new industry and a growing company, they're not always able to make cash from their operations. Which is why many new companies keep issuing stock and taking on debt or diluting the share price to get financing. If we go quickly back to the balance sheet, you'll see they had $500 million in cash last year. Then a net loss, then their operations only made $60 million. So how did they get $1.1 billion in cash? If we go back to the latter half of the cash flow statement, look at this perfect round number. They issued 7-year notes and received an even $1 billion in cash from issuing this debt. I love this. They used the funds to repay notes with an earlier expiration, which was 2022. But also, they didn't issue shares to get financing, which is the most expensive form of financing. It's basically being in debt forever. But they don't need to dilute the share price in order to get cash to fund their growth. Now onto the part nobody asked for, my opinion on the stock. Should I buy it? Should you buy it? First of all, I love the company. Looking at their financials, the company looks great. I like it. Am I going to invest in Teledoc? The answer is no. When dealing with growth stocks or speculative investments at this point in my investing career, I'm looking for companies that might increase by 5 times, might increase by 10 times. And I'm just not seeing that in my crystal ball for Teledoc. It's obvious that Teledoc has already experienced that growth and I've missed the boat. They've already increased by 10 times. They're already worth $30 billion. If you look at CloudMD or Well Health Technologies, please check out my previous videos on those companies. They're more likely to hit that 5 times growth. They're earlier on in their product life cycles. I don't think I've missed the boat on those. Will Teladoc stock double in price? The answer is probably yes, but CloudMD and Well Health are more likely to double and actually sooner. So if I were to invest, I only have a finite amount of funds. Like you're probably thinking, why don't I just invest in all 3? But I don't want to be too deep into one industry. And if I were to invest, I'm looking for 5 times growth, 10 times growth, and I'll be investing more in Well Health and CloudMD, not Teledoc. There you have it, folks. Another stock analysis video. I actually wrote this one 3 weeks ago. I haven't had time to film it and edit it. I've just been bogged down with life and with another full-time job. But I promise to keep these coming. I actually owe everyone a Lightspeed Q3 analysis, which should be out soon. I owe more Toronto real estate investment analysis, and I'm actually waiting for CloudMD's new Q3 statements to come out so I can release an updated video on those as well. Please check out my past videos on a couple Canadian growth stocks to buy, a couple Canadian dividend stocks to buy. Although I filmed them 6-7 months ago, they're still relevant. I still stand by those videos. I still invest in those companies. So until next time, thanks guys.